Well, I think they might have been, Sarah, taken a little bit by surprise, particularly in light of both the pre-FOMC statements from a number of members and also the statement itself, which had suggested a bit more concern with inflation. Obviously, the use of the term by the chair repeatedly raises three questions. The first, is the lower inflation reading transitory? I mean, surely some of the factors are, but over the last 7 or 8 years, there have been a lot of factors cited to explain the lower inflation, and most of those go away and then some others take their place. Second, what is it going to take for the Fed to determine that it is not transitory and they need to do something about it? You know, if you put a lot of weight on inflation expectations, those are already creeping down a bit. If you put more weight on actual inflation figures, in the last 7 or 8 years, we've been above 2%, only a relatively few number of quarters, and below more. So I think that's a bit of an issue for the markets as well. And then finally, and maybe most importantly, how does this all fit in with the framework review that the Fed is doing of monetary policy generally? That is, how important is it to get up to that symmetric target of 2% and sometimes over it? And I suspect that markets and analysts will be asking that question as well.
Dan, to that point, even if inflation below 2% became persistent rather than transient, does that matter so much when the other readings on the economy are looking pretty good and even improving?
Yeah, I think it does, Wilf, and I'll tell you why. I mean, right now, remember, in a recession, a significant recession, not the Great Recession, but any significant recession in the post-World War II period, the Fed has generally reduced the federal funds rate by somewhere between 350 and 600 basis points. Right now, with federal funds rate at 237, or between 2.25 and 2.5, they don't have that much room. And with the neutral real rate of interest thought to be a good bit lower than it used to be, there's not going to be that much room. So if inflation is running below target, there's going to be even less room for the Fed to respond with stimulus in the case of a downturn. And so I do think this is an important issue. And it's also an important question for the Fed after a decade of below target performance, which is somewhat understandable in light of the Great Recession. How important is it now to get back to the fluctuation around 2 rather than always just approaching and then dipping back down again?
Is that only really totally crucial if we start to see a recession again? Kind of use Europe as an example, where you might be seeing the data turn meaningfully south, but rates already towards the lower bound.
Sure. Well, you could obviously worry about liquidity trap issues and the like. I don't think those are the immediate concern. I personally have been more concerned with the Fed's toolbox for responding to a recession for some time now. And I think you've heard from a number of current Fed members over the past couple of years that they are too. And that really is an important issue for them. It ties into inflation, although it doesn't define the inflation issue entirely.